This is Tulio Siragusa with Dojo Live. Today is Tuesday, August 11th, 2020. I am talking today with the co-founders of Elucidate. We're going to be talking about an interesting topic, defining the standard for financial crime risk management. But before we do that, I want to welcome my co-host, Carlos Ponte, just outside of Mexico City, and Kim Lantis in Hermosillo, Mexico. Hi, guys. Welcome back.
Thank you, Tulio.
And let's get started with introducing our guest today. We have Shane Riedel, who is the co-founder and CEO of Elucidate, and also Felipe Garcia, who is the co-founder and CTO. Both of them are coming in from Berlin, Germany. So we've got an international contingency here going on in Dojo Live today. Shane, Felipe, please introduce yourself. Let us know a little bit about you.
Sure. Felipe?
Hi, I'm Felipe, originally from Portugal. I moved to Berlin around 8 years. I've worked with a lot of startups with different domains. In the previous company, I was working in fintech. I really enjoyed this highly regulated business, so I decided I wanted to do something on that space. So that's when I met Shane. We started to talk about the idea of Elucidate, how to make this problem that every single bank in the world is doing manually and by themselves, but now on an automated way and with help of technology.
And I'm Shane Riedel. I'm the CEO. My background is in finance. So most recently, I ran the risk and compliance portfolio for financial institutions at Standard Chartered Bank, the English bank. I started in finance with Goldman, and before that, I was a diplomat with the UN. But I'm from America originally. Grew up in rural Ohio.
Diplomat with the UN, that's a whole nother conversation in itself, right? So let's talk about Elucidate. Tell us what gave birth to this idea, what's it all about, what does the company do?
Sure, yeah, I'll take a stab at that. So in essence, the problem that the genesis of this was that there's really a systemic problem within financial services, and that is that financial institutions really struggle to gain access to the data that they need in order to assess and manage the risk of other financial institutions. So it's relatively straightforward to manage financial crime risk when you're talking about retail or corporate customers, right? Because you have a lot of data on those entities. But when it comes to transacting with other financial institutions, you don't see who the underlying customers are, and so it becomes much more challenging. We wanted to sort of sit in the middle of that relationship and to provide transparency between all market participants and a greater, richer data analysis for them to use in judging and assessing risk and ultimately predicting and preventing it.
Exciting. We're looking forward to learning more. And Kim, please, let's introduce the show today.
Sure. Thank you, Tulio, and thank you, Shane and Felipe. I'm sorry, for being here today.
Felipe.
Thank you. I'm sorry. So perfect. So today we're talking about specifically defining the standard for financial crime risk management, which is what your company is all about, and specifically using machine learning for a data-driven approach. So we already talked a little bit, but let's kind of set the foundation here for those folks who might not be familiar with why it's so critical and why it's so important to have, this crime risk management. What is this all about, and what's the basic foundation for this sector?
Yeah. Okay. So I think there are two things probably worth bearing in mind. One is let's say regulatory, and one is social. And we'll start with the second one first. I think a lot of times we lose sight in reg tech. We lose sight of the fact that fundamentally we're defending a social good here. So financial crime is a massive societal downfall. Having started out as a diplomat for the UN in Central Asia, I saw firsthand the impact that things like corruption, people trafficking, arms smuggling, narcotics can have on the fabric of society. So, we like to say in the company that our vision is to rid the earth of financial crime. And what really gets our people coming to the office every day is the fact that they're doing really interesting technical stuff, but fundamentally they're solving a very big social problem. On the regulatory side, though, one doesn't need to think very far back in the past to see that that there have been massive financial crime scandals which are coming up sort of fortnightly these days. And going back a little bit further, HSBC $2 billion, BNP Paribas $9 billion. I mean, these are massive sanctions and fines being levied against financial institutions, which certainly have the effect of focusing minds on this issue within the financial sector.
It's an interesting dilemma because often people think, well, it doesn't affect me, right? It only affects a big corporation, but we're actually all paying for that. And banks and financial institutions, I've been at this for a long time, trying to curtail and get ahead of it. What makes what you guys are doing different and unique in terms of creating a value that's more data-driven? Is it predictable? Tell us a little bit about how it works.
Sure. So what happened with on the credit side, John Moody's created this rating on the credit side 100 years ago. This was needed at the time. It's still needed now. In the industry, they were doing credit assessment before, but with Moody's on the rating, they start to do this a bit more defined. With the regulators start to look at this, and they start to create some parameters around that. Financial crime already existed before. Financial crime prevention already existed before, but only with 9/11 it started to become a real thing on the industry. So it's really new. The banks start to work on that. Everyone start to create their own framework. They have the big agencies that are doing this assessment. They go into a lot of banks. They do the work. Then they have to keep the business going. So there's no sustainability on the product itself. It's more on the contracts that the companies have. So what we started to create was a benchmark that the whole industry can use. Basically, everyone that we assess can compare themselves against everyone else. So we have an algorithm. Instead of having one person looking to the data or talking to the people, going to the bank, and then being able to say, I think that this is the score of that institution. The algorithm ingests some data. It produces a score, and this is useful because you compare yourself against others.
What were some of the factors that went into determining what that benchmark is?
Yeah, so we have a lot of knowledge about the vertical. So we have Shane doing this by himself for many years. So he knows the vertical, he knows the space. And this is what initially started to become the standard, right? People like him are doing this. Gathering a Delphi panel that is able to work on this and validating this is also very useful. We also have our board that is helping us to defining the standard and giving us input on that. Shane, do you want to follow up?
Yeah, I think what's probably a key differentiator, though, we've got this Delphi panel. It has industry leaders on it. And so I think our expert judgments are probably as good or better than anybody else out there. But I think what's a real differentiator in our modeling is that we've not only focused on industry or sort of domain expertise, but we've also brought in probability and used machine learning to drive a probability assessment. So how likely is it that a certain data attribute is going to result in a financial crime risk event? For us, this is a huge differentiator. We're enabling the market to sort of pivot from an environment where most of your resource, and the estimate is that banks spend around 3% of revenue to manage this risk. Most of that resource is utilized to detect and report when something bad has happened. Whereas we want to really pivot the industry towards a predict and prevent model of understanding where risk will arise. In the same way as Felipe said, as John Moody's did 100 years ago when they applied that kind of robust modeling and analysis to credit risk.
Right, because I think it's easy, at least for me, someone who's admittedly very far removed from the financial sector. But 3%, it doesn't sound so bad. But in terms of what this 3% actually means for such giant financial institutions, what is that number?
Yeah, for for Citibank or JP Morgan, we're talking somewhere in the range of $2 billion per year. So it's not chump change. And for a lot of smaller institutions, that number can be significantly higher. So it was reported recently that one of the Dutch banks, ABN AMRO Bank, they had 10% of their staff working on this issue. Now, fundamentally, to the earlier point that was raised, Tulio, this is ultimately coming back to consumers, right? They're carrying that cost. It's not free. So we don't think that it is sustainable for the industry to rely on a system that has hundreds or indeed thousands of people manually reviewing particular data attributes as they kind of exceed thresholds. In this day and age, we can obviously do much better.
So I'm curious, let's talk a little bit about the technology. You said you have an algorithm that you've developed that's advanced for our time. Is it something you've adopted, like a Berkeley stack, or something you've built yourself? Can you tell us a little bit more about what you're using?
Sure. So we built it ourselves. We have a lot of data that we use from the public domain. We have a lot of data that we use from the regulators that we ingest into the algorithm to be able to calculate the probability of a financial crime event happening. Then we receive data from our customers, and we have to clean this data. We have to use it into our universal standard, and then with this we are able to see all of those events if they are happening. And then in our modeling we have those two components, the probability and the impact, how bad something is and how often something happens. So with those two components we are able to calculate the score for one institution. This score helps the institution to look about what is the score depending on the theme, depending on what we are analyzing, and it's not a black box. It's something that they can use and they can improve their own score. Right? We have to disclose what the risk is, and we have to tell them how to improve that as well. So it's not something that it's a machine learning algorithm that data goes in and data goes out, but it's something that we help them improve on that.
So it's more of like an assisted analytics engine. Is that a fair elementary assessment?
Sure, yeah.
You still have people that have to look at it. And what is your sweet spot customer? Is it large tier 1 banks, tier 2? Who's actually at greater risk? I'm curious to find out which institution at greater risk.
Well, we've got one of the sort of top 3 US banks as a user today. We also have the largest bank in Afghanistan using the product, and we've got loads of users in between those two. So, to my view, when you've built a tool that is applicable to those extreme use cases, that speaks volumes to the universal applicability of it. That said, I think our what we consider to be our perfect user at this point is really mid-tier banks. So mid-tier banks, I think, benefit from both of our use cases. That is to say, they're able to use our modeling to understand their own risk, to improve transparency and governance within their institution, to set KPIs, all the good things that come when you have a metric. They can utilize those internally, but they also have large portfolios of other banks, of counterparties with whom they're transacting on a regular basis. So banks in the U.S. market. Banks, the sort of, the Huntington, Zions Bank kind of tier of banks, or in the European market, ING or BBVA, Santander. Those are for us really the optimal customers, which benefit from most of our application.
So who are the pundits, if you will? Who are actually causing the majority of the fraud? Where is it coming from? Who are you? Is there a pattern you guys have identified with the platform? Any particular
Yeah, I mean it's an interesting question. I would like to say that it's what the media and industry bias says it is, which is to say that it's Russians operating through offshore companies. I think the reality is that it's far more complex than that. And what we find is that financial crime is not isolated to a specific segment. That we do see it across the banks that we deal with. No, I don't think we've looked at a bank yet that it has no financial crime risk. And what I think is really telling for us is that we tend to run our model on banks who have controls in place, right? These are banks that from September 11th until now have been investing in this risk, have lots of transaction monitoring and all of these things. And when we do historical assessments of banks, the sad reality is that we find things, and we find really big things. So the problem with the way that the industry looks at this issue is that it's deeply tactical. They look at a specific transaction to understand, should I tell FinCEN about this? Or should I tell law enforcement about this in the US? And what we find is that when we step back and we actually look at the entirety of a bank's risk, that we've identified where there are massive changes in their risk profile, and none of the tools that are out there actually tell them that that's happening. So there's clearly a deficiency in the market. Regulators continue to find them, but there's just not a tool out there until now that really addresses this at a systemic level.
So let me get this straight. Not only are they at risk, they're losing billions of dollars, but if they don't have a program in place to curtail this, they get fined on top of that. Is that correct?
Yeah, and that in a lot of banks, I think these days they probably say it's the cost of doing business because there's not a better option out there.
So who's your actual customer? Who's buying? Who needs to be looking at this? Is it what group in the bank is actually responsible for this? Is it the compliance folks? Is it the risk folks? Who's your client?
Yeah, we've got a variety. So we've most often, to be honest, our buyer is the head of the financial institutions group at most banks. It's the person who's responsible for their relationships with other financial institutions. And that's the beauty of putting a value against this risk, is that banks will begin to price this risk in the same way that they price credit risk. Today, nobody knows what is investment grade financial crime risk or what is subprime financial crime risk, right? Like that benchmark isn't there. By introducing that metric to the market, we're able to say, look, this bank presents higher risk. It's going to cost more to manage that risk. You should you should price accordingly. And I think that opportunity is viewed by the financial institutions or the business within a lot of banks as having upside in addition to just managing risk more effectively. But we also have buyers in compliance and risk as well.
It's really smart. I mean, this is a completely different vertical, but a while back I came across a meme that was talking about like our carbon footprints, like our zero waste mentality. And it said something to the effect of 1 million people doing zero waste imperfectly has a greater impact than 100 or 1,000 people doing zero waste perfectly. And so that's kind of where I'm hearing here. Like if we can get everybody on board doing, even if it's imperfect risk management and prevention, it's going to have a much higher impact than 1, 2, 3 banks doing it perfectly, right? So I think that's right where your product fits perfect. You've mentioned now, I think twice in today's talk, the shift from 9/11 and when banks and financial institutions began taking this more seriously. What, obviously terror aside and the horrible incident that happened, but what was it specifically that was the cause of this
Yeah, well, I think it was about September 14th that Cheney introduced the USA Patriot Act to the legislature. So that provided the regulatory framework, which has obviously evolved since, but it's sort of enabled U.S. regulators to start taking a more heavy-handed approach to this. I think Europe has come a little bit later to the table, but has done so now with a certain gusto. So you see. The European banks now being the recipients of significant regulatory scrutiny. What's also really interesting, I think, from our perspective, is that unlike in a lot of the US cases of financial crime, when the Nordic banks last year or the year before, when they came into some problems, so Danske Bank, for example, Danske Bank's share price went down by half. As a result of a financial crime scandal. Raiffeisen's share price went down by 14% in one day. So the market also wants to price this risk. And I think you're seeing that in a very pronounced way. But is Danske Bank worth half of what it was before? I don't think so. My personal view is that it's not. But in the absence of a metric to actually judge that, the market has vastly overreacted and priced accordingly.
I'm going to jump in because I have a question, and what I was wondering is, although these topics for me personally are a little bit like beyond my usual knowledge of technologies, but we're talking about financial crime risk management. So in this context of managing or even perhaps avoiding financial crimes, what role does technologies like, for example, blockchain or cryptocurrencies have? And because by definition, cryptocurrencies are something new, or very new in the world of technology. So what role does this particular financial technology play in financial crime risk management? I'm just kind of wondering about this.
Yeah. I think so. People use blockchain like they use money, right? They were doing financial crime before when there was fiat currencies, and they will be doing with the next currency as well. So it's not something that is enabling someone to do more or less. It's just another way for them to do that. One thing that I remember so a lot of banks have a lot of fear for blockchain. They think that it's out of their scope and they cannot see what's happening there. I remember talking to someone from a bank, a really big German bank, and they were saying, yeah, we don't do business with anyone doing something with Bitcoin. And I told them, well, you do, because I have an account with your bank and I transfer money from one exchange to my bank account. So the money went from your system to the blockchain, so to buy, for me to be able to buy Bitcoin, and they didn't know about this. So it's obviously that the money goes from them to Bitcoin, to another cryptocurrency, and then goes back to their system, and without them knowing. We don't see blockchain as a specific risk. It's obviously a risk, just like any other currency. But it can, as a technology, it can be an enabler for us, for example, to use blockchain as a digital notary. So every time we produce a score in our system, we hash all the data that we receive. We hash that data embedded into the report, and then this report is also hashed, and we store that into the blockchain. So this tells us that at this moment we use this data to produce this report. There's a proof that we didn't tamper with the data. The customer sent us this data. We produced this report, and then it can be validated 5 years in the future if someone needs to.
Thank you so much, Felipe. Well, I think we should probably touch a little bit on the shift towards more on the company culture side. So I'd like to ask you about Elucidate. What would you say that makes Elucidate a great company that people, developers or engineers, would want to work for?
Yeah, it's an interesting question, and probably as founders we've got our own own feelings for why we like the company. I will say we've had a really low level of attrition, so evidently people do like it. I think on one point is that as I noted earlier, we make it's very important to us that our team internalizes the fact that we are performing a service to the banks and the societies in which we operate, and that there's a social value to what it is that we're doing. I think that's really important, and you feel that sort of sentiment when you engage with the team. At least I do. So I would say that's one characteristic, but one of the benefits, I think, to being an early stage company, and we've just closed a financing round, but prior to that we were bootstrapping, and so we're pretty small, so under 10 people or around 10 people, is that that kind of an environment, when you've got a relatively small team, operating under a lot of pressure with aggressive deadlines, it really builds a sense of interdependence and trust within the organization, and a shared understanding of what everyone's doing and a support for that. And I think that served us really well. I mean, Felipe, maybe you have other points you would add.
Yeah, sure. Also the fact that we, both of us, hired a lot from our previous employers at least tells us that we got people that like to work with us, and we like to work with them as well. So in the beginning, everyone knew each other quite well, and we were never a family, of course, but we know each other quite well. And the office environment that is now shifting to the virtual office environment, it's still very good.
I like your comment
so much.
about creating an interdependent team. We're very big on that. We don't think codependence is healthy, and typical command and control companies, it stifles creativity and innovation, not to mention it disengages employees. And we also don't think complete independence is ideal either, because it creates a sense of too much individuality, not enough teamwork. So congratulations for balancing that. We agree that's a really big, important step. As you start to scale, as you start to build this out, fast forward a couple of years, what would be like a big leapfrog moment for you guys that would say, you know what, we have this vision, this dream, we've now hit the mark and we're off to the races? What would that look like?
Yeah, sure. I mean, for us, we've tried to keep that the articulation of those objectives pretty tight, and clarified in a way that the team, regardless of where they sit or what they're doing, and as you say, when you start scaling, this becomes more challenging to do, because it's not so much based on interpersonal relationships anymore. And indeed, now some of our new hires I actually haven't ever met in person yet. But what we've tried to do is to articulate, for us, it's sort of four main objectives that we want to achieve. We want to be the standard. We want to make it easy for our users and enable data integration. We want to be secure, and we want to show that we can drive a multiplier effect through the adoption of our platform. And by keeping those objectives pretty simple, that really enables the team to have shared focus, to ask themselves the questions: does it help us to achieve one of those four objectives? And I think that ensures we maintain that interconnected nature that served us so well through our early stage.
Well, sounds like you guys have a good thing in the making, and definitely a must-have today. I'm assuming there's probably some additional risk coming because of COVID and the immense amount of unemployment. I can only foresee risk and fraud grow. So you have a great opportunity ahead of you as a business, and certainly from a social economic standpoint, a chance to make a difference in the world. So congratulations. We wish you a lot of success, and thank you for joining us today. We're wrapping up. We're up on time. Carlos, what do we got coming up? We have two more shows this week, or one more? What do we got?
Yeah, actually, We have two more shows, Tulio, one tomorrow and one on Thursday. Tomorrow, we're going to be speaking with Kimberly Wiefling from Wiefling Consulting about a very interesting subject that I look forward to, which is overcoming the global pandemic of dysfunctional organizations and disengaged employees. Catching my breath here. Okay. And on Thursday, we're going to be speaking with Jeff Haney, the co-founder and CEO of Pinpoint. And the topic is AI and software, streamlining developer workflows. Those are the two topics remaining for the week, Tulio. And that's it. Right here in Dojo Live, 1 p.m. Pacific, as ever. Thank you.
Thank you all. Stay with us as we wrap up. Stay safe.